We'll get the management of Sai Life Sciences. That's the new kid on the block that's opening up for IPO next week, starting 11th of December to the 13th of December. And the price band is going to be between 522 to 549 rupees per share. In fact, the total issue size for this is 3,042 crore rupees, out of which the fresh issue is going to be 950 crores and the offer of sale is going to be 2,092 crore rupees. But let's get the management on board and tell you more about the company's growth roadmap ahead. Krishnam Raju Kanumuri, who's the MD and CEO, and the Shiva Ramakrishnan Chittor, who's the Chief Financial Officer of Sai Life Sciences. They're joining us now. Hi, good afternoon to both of you, and thank you so much for joining us. Mr. Kanumuri, coming to you, tell us about your business. Also, what's your geographical mix? Take our viewers through your business model first.
We are a contract research and development company. We are end-to-end provider from basic discovery services all the way to commercial manufacturing. Our customer base is innovators only. We work with 18 of the top 25 global pharma companies and a lot of emerging and biotech companies. We basically are geographically spread from an operations standpoint in India, Manchester, UK, and basically Boston, US. We are probably one of the fastest growing CRO CDMO in the world at this point, growing about 30% CAGR over the last few years, EBITDA growth of 50%. And we continue to see a lot of momentum in this business. This is an emerging sector in India in terms of what we are seeing in the global tailwinds. I think India has a very strong position overall in the upside potential in this industry for the next 5-10 years. There are several factors which have been instrumental. India itself has been in this business for the last 20 years plus, and China has a lion's share of this market. But a new law has come in the US called the Biosecure Act, which mandates that some of the companies working in China will have to move away from some of the Chinese partners by 2032. And this is giving a big boost to companies coming to India to at least build scale which is comparable to what is in China.
Okay, thanks for that view coming in. But also, Mr. Kanumuri, tell us that there has been a new law that you are seeing, but there's also been a new government that has now come in place, and this can impact innovators as well. What's your view on the same, and how does this impact your business?
So, innovators, I don't think are going to have a substantial impact in terms of their operations. I think there's some indications in terms of what may happen at FDA level approval, but there's no clear indication that healthcare in US is going down or that there's a reduced demand for healthcare. There might be more pricing pressure on the market, and if anything, that should benefit us. Fundamentally, the fact of the matter is the global population is aging, and the need for innovative care is going up more than ever, and this market is continuing to see significant growth over the next several years. Nothing is going to change that trajectory, just given the needs of the population.
All right, coming to you, Mr. Chittor, then you are using the funds to reduce your debt. But after the IPO, what will be your DE ratio, and how will you fund your growth then?
So I think, as you correctly pointed out, I think significant amount of the funds that we are going to raise will go to pare down our debt, which would actually reduce our debt to a very negligible number at the end of the next year. What this will help us do is to kind of help our balance sheet become stronger. Now, as we kind of grow, and kind of put capex, I think the way we would define our expansion plans into two categories. One will be about making sure we make the right technological investments that are important from continuing our service and our capability as an innovator service provider. The second one will be a consequent impact, which will then increase our capacity. We will continue to invest in both of them through a mix of going to debt and internal accruals. That's the strategy for the next few years.
Okay, Mr. Chittor, let's highlight a little bit about your financials. Throw some light there, because your cash flows in the last 2 years were negative. Now they've become positive in the September quarter. Now, why, help us understand, why is there such volatility in the cash flows, and also your growth rates are pretty good. However, your return on equity is amongst the lowest when it comes to the industry amongst your peers. What justifies that?
The last 3 years has seen a significant growth in terms of how we are positioned. If you look at our revenues, we've grown more than 30%. Our EBITDA CAGR has grown up 50%. Ratios with respect to working capital have improved significantly. Our balance sheet is coming down better. If you really look at, we will pay down the debt. So all of this will kind of ensure that our overall, we are positioned for a better return on equity. Today, where we are to what, if you look at the growth from fiscal 23 to 24, the number has been significant. If you look at where we are positioning this business for a consistent growth in revenue, profitability, and reduction in debt, this will help us improve our return on equity in the coming years.
All right, gentlemen, thank you so much for taking the time out and joining us and giving us the details of your company. But we will let.
If you like this video, then like, share and subscribe to ET Now.